Markets get positive on Powell, but with a negative edge on Mideast risks. Welcome to Market Insight. I'm David Pollard. Jerome Powell's much-awaited speech on Friday fueled optimism across markets. The Fed chief telling the Jackson Hole Symposium that the time has come to cut interest rates. But these pictures of clashes between Hezbollah and Israel could highlight the need for caution on fears that any further escalation may morph into a regional conflagration, impacting energy prices and the geopolitical outlook. So what does it mean for the US? Well, let's get a view from Lydia Boussour, Senior Economist at EY. Let's start with Powell, who made it clear on Friday that the weakening jobs market in the US is a top priority. Does the Fed now need to play catch-up on rates? Has it been too slow to react?
Yeah, so the Fed Chair Powell on Friday really completed that pivot and to a more dovish stance and away from this this more hawkish inflation worry stance. We saw Fed Chair Powell essentially strongly telegraphing that a rate cut is coming in September. Now he also retains some optionality when it comes to those rate cuts and the magnitude of those rate cuts. He did not make any reference to a 25 basis point rate cut. He did not mention whether a 50 basis point rate cut would be on the table. So the key question is, how are they going to be proceeding in September? Our view is that, given the resilience we continue to see in the economy, the Federal Reserve is likely to be proceeding cautiously, and we expect to see a 25 basis point rate cut. But if we were to see a material deterioration in the outlook, if the August jobs report would be, quite weak, the Federal Reserve, I think, would put that 50 basis point rate cut on the table. But I think right now the bar is still somewhat high, especially some of the other commentaries that we heard at Jackson Hole last week.
And in the view of EY, though, is the Fed behind the curve when it comes to a weakening labour market?
Our view is that the Federal Reserve is somewhat behind the curve. We've seen that disinflationary trend and that disinflationary environment for a number of months. When we look at the overall inflation outlook, there are a lot of disinflationary forces at play. We have a moderation in demand, a moderation in economic growth. We have a labor market that have come back into balance and that is showing clear signs of softening. We also have more disinflation in the pipeline on the housing front, and we are also hearing in our conversation that pricing power has also decreased. So all of these factors point to a sustainable, disinflation trend. And so in our view, it would have been optimal to start lowering interest rates and moving away from that restrictive policy stance at the July meeting. We were previously expecting 2 rate cuts before year end. But we do think that the Federal Reserve will need to proceed with more rate cuts, and we now see 3 25 basis point rate cuts before the end of the year.
Before the Fed's September meeting, policymakers get lots more key data, the PCE price index this Friday, not least of all, then August jobs report, GDP numbers, etc. What do you expect to see, and where do you see potential risks for any shocks in those numbers?
Well, I think the key focus is really going to be on the August jobs report. The inflation numbers this week, the PCE numbers, are going to be very important as well. Now, looking at the consumer price numbers, looking at the PPI numbers, which feed into these PCE figures, our expectation is to see prints on the soft side around 0.2% month over month for both headline PCE and core PCE prices. Now, with the Fed strongly focused on the job market and highlighting the fact that the downside risks to the labor market have increased, we will really need to see what kind of labor market data we got in the August jobs report. Whether that uptrend in the unemployment rate is sustained, whether the payroll growth also remains quite weak. If that's the case, then I think the Federal Reserve will be considering that 50 basis point rate cut. But if not, the Federal Reserve is likely to be proceeding cautiously and opt for a 25 basis point rate cut. But more generally, I think looking at the labor market outlook, our view is that we're likely to see a continued softening in labor market conditions, but we do not expect to see a significant retrenchment and a broad-based rise in layoffs. So that's really behind our view for 25 basis point rate cut at each of the next few meetings before year end.
Now we refer to the Mideast conflict, which looks like it is deteriorating. So the wild card in the outlook has to be energy prices, doesn't it? Or do we assume that the US, with its own huge energy resources, is still fairly immune to how geopolitical events hit energy markets?
Yeah, geopolitical tensions are an important risk that we are monitoring and that we've been flagging in our global economic outlook as an important risk, to both the economic outlook but also the inflation outlook. We see oil prices, a potential oil price shock, as a key upside risk to inflation. Now, when it comes to oil prices, I think it's important to think about the magnitude of the increase in oil prices and whether that rise in oil prices is sustained. Now, we've done some modeling, and in general, if you have a $10 increase in oil prices, that would tend to boost consumer price inflation by 0.2 percentage point over the next 12 months. So we'll be closely monitoring these oil prices. The Federal Reserve is also going to be looking at that. At the same time, they tend to look through any near-term volatility and spike in oil prices. So I think the key is really whether any increase in oil prices is sustained and whether that then feed back into higher inflationary pressures.
Lydia, we'll leave it there. Thank you very much, Lydia Boussour, Senior Economist at EY, for sharing your thoughts with us today. That is Market Insight. You can watch more videos on Reuters.com.